Hi, everyone. Thanks for joining us this afternoon. What we wanted to go over today is more specific topics in regards to APC. So what we're going to share with you today is we're going to go over seasonality and market conditions. So from an example, we're going to break down the two and show how they interact as well. So let's get started here. So we're just on the home page here on APC. So I'm just working out of the Charleston Regional MLS at the moment. But let's go through and let's just create a new chart and show you how this affects based off of seasonality and market conditions. So I'm simply going to come here and do a property value analysis. And on here, and for those of you, we do have investment analysis now as a separate tool, but we're just going to do the property value analysis today. So on the property value analysis, let's just pick a house that we have. Let's just say it's this 123 Main Street. And I just want to show you how seasonality is influenced and it's specific per MLS and per market. But let's just do run a set of analysis for this 123 Main Street. So it's a residential house. Let's do single family detached. I'll just pick a neighborhood here. So let's just do, we just want to get some comps. Let's do Bell Hall. And price range, let's just stay under 550. And then let's do, just for the start of this analysis, let's stick with a year. So just to show you the full seasonality effect, we're going to do 12 months of comps. So when I hit search, what we're going to find is that we're looking at a full seasonality span. And I understand that, you know, this year is obviously different than other years from a seasonality basis because we're dealing with COVID, but this is off historical, 2019 and before MLS data specific to your MLS. So if you're in Miami, that seasonality curve is going to look different than it will in Buffalo, which will look different than, out west. It's all a different seasonality curve. So what we're finding here is we have 44 closed comps. And on those 44 closed comps, we see 2 pending and 3 active. So just because we're running a seasonality, I'm going to generate this chart. Don't pay as much attention to the overall numbers, but here's the chart for this analysis. Now keep in mind we're taking 12 months of comps. So these houses, these 44 houses closed over the past 12 months. So if I go to my list and I look at my close dates, so you can see the most recent one closed 6 days ago, so June 18th. But then we go back in time, you can see the seasonality for this market, and you can see when they all closed. And you can see a lot of closings last June, keep in mind this 2019, July, August. So watch what happens. August, now there's only 1 in September, 1 in October, nothing in November, December, and then all of a sudden January picks back up. So there's some January, February, March closings, April, May, and even lots in May. So keep in mind, even with COVID, lots in May, and then a few in June. So what this is showing is that there's a lot more sales in this market during that spring, summer time period, which is very typical. So there's a lot more sales. So what we're doing is we're analyzing the seasonality. So you can look at your sold dates and keep in mind we're doing 12 months. So I just wanted to show you what happens is that if we look at the seasonality and we run this analysis today, we're basing it off of a June 24th analysis, right? So on June 24th, what we're saying is compared to the 44 closed comps, we're still giving a positive credit on seasonality for a house that is listed and under contract today versus the 44 closed comps that closed in a time period of 12 months. So we're giving a positive seasonality adjustment. So for your seller who says, well, I'm selling in the spring or summer, I should get a credit for a higher value for my house. Yes, we are taking that in consideration. So you're addressing that right here with them. So let's go back to the chart. Let's say you go on that listing appointment today and the seller says, well, thanks for coming out today, but I think we're going to finish the year out in this house and we'll sell towards the end of the year. The program allows you to go, let's pick a date towards the end of the year. So let's just fast forward 6 months and we'll pick December 24th. So if we pick December 24th, what it's going to do, it's going to analyze the 44 comps again based off of a new date, and that new date is December 24th. So what it's saying is now you have a negative adjustment of almost $5,000 based off of, okay, you want to sell in December versus June 24th. Well, we're actually going to debit the house because you have to be more attractive to those limited buyers at that time of year. So you can see that was almost a $6,000 or $7,000 swing between a June 24th date and a December 24th date. So, this is what the program is doing internally for you, is it's comparing your date that you select down here on the seasonality, is comparing the date you select to when the 44 closed comps sold. So any one of these closed comps, it's analyzing that date, that sold date, and compiling all the information and comparing those dates to the date that you've selected. So I just want to run another example for you. Sticking with seasonality, so it's the same comps, right? Same criteria, except now I'm going to limit it. I'm going to say, okay, let me just pick 3 months. So let's do, 3 months. Let's do March 24th to today. So if I do 3 months of comps and I run my analysis, there's obviously going to be a lot less data. So we're eliminating a good 9 months of the comps. Whoops, sorry, I did not get the right year. So 2020, let's do 2020. So let's do 3 months. So 3 months of comps, what we're showing is we're eliminating most of that data. So now we're down to 14 closed comps. You still have the 3 active and the 2 pending, so that hasn't changed, right? So those are the same ones. Now if I generate the chart, what it's going to produce for me is a different analysis with a date of same date, June 24th. So let's go look at the analytics. So if I look at the analytics, now the credit adjustment is not quite as high, because keep in mind, most of these comps close in the better, or were under contract or closed in the better time of year. Well, the ones at the end of March, maybe they went under contract in January, not quite as good, but getting better. So just to continue this exercise, let's do this. So here's our seasonality adjustment, right? Let's go to our list, and we have 14 closed comps, and remember, we have to have 7 to run the chart. So you can see there's less of adjustment because more of these homes close in the better part of the year from a seasonality basis. So let's go back to our list. So I go back to our list and our closed comps, let's do this exercise. And this is specifically for understanding seasonality. So if I go back and I start deleting the comps from this early spring, and I say, okay, let me get rid of the one on March 24th. I'll get rid of the one April 15th. I'm just deleting from the back end of the list. We'll get rid of this one here, and let's get rid of the 2 on the May 3rd. So now what we're doing is we're consolidating that information, and now we have closings. Keep in mind, closings from May 14th to June 18th. So a little bit over a month time period. Now if I go back to my analytics, so now there's almost no adjustment, very minimal adjustment, right? Because now I've consolidated my list, and the list is very similar in seasonality curve to the date that I'm selecting. So you can see as the comps, each comp has an effect on seasonality based off of that close date. So if I have a very limited window and it's very similar to the subject property, it's going to be a very limited seasonality adjustment. Now, if I go back to my chart again, just to finish this conversation, and I go back here and I say, okay, let's take that same house and let's try to sell it in the winter, in the harder time. So let's do December 24th again. Now let's go look at the analytics. So now the analytics are almost down $7,500. So you're asking yourself, well, why is that even more than before? Well, keep in mind, our list, the comps that we're analyzing are all this peak season comps. So all these comps close near the peak of the season. And now we're saying, but for the subject property, we're going to try to sell at near the low of the season. So that swing is saying from the peak to the valley is that adjustment of almost $7,500. So you can see how each comp and date matters in that seasonality adjustment. And that's kind of what happens in real life. If you're analyzing and you're using a set of comps and you're changing the comps you use, certainly the analysis should change. But also, if you're selling the house on a different date, then that analysis would change as well. So you can see how seasonality comes into play with the market and how it is affected by which comps you're selecting. So let's tie them together. Now keep in mind, seasonality is one factor. So let's look at market conditions. So I'm going to go back and I'm going to start this chart over again. So let's go back, modify the search. So now put seasonality in your head, and that's one adjustment. Now market conditions. So let's go back and do the same analysis here. So let's go back and do 1 year. So we'll do June of 2019. We'll do June 24th, right? So when I run this set of comps with this criteria, then I'm going to have 44 closings. So that's a lot of closings. Traditionally, I would not run analysis, with 44 comps. I would narrow down that time frame if I have that many comps in this neighborhood. But for this example, let's use this as a part of the analysis. So now when I generate this chart, so remember when I generate this chart on my analytics tab, we had a positive seasonality adjustment. Now let's look at the market conditions adjustment. So in the market conditions adjustment, what we're saying is that we believe that this market with a positive adjustment of 48.69, what the analysis is saying is that we believe this curve, this best fit curve of the sold properties, is moving up over time because the value of these properties is going higher over time on an appreciation basis. So blank out seasonality from your mind for a minute. So this is strictly long-term. Is this housing market going up or down in value, over the bigger picture? So what we're saying is that we're analyzing this, and we know there's 44 closed comps in 12 months. So we are closing almost 4 a month. So if we're closing almost 4 a month, and we have 3 for sale, we only have 1 month of inventory. So we put this market conditions monitor right here to show you specifically for this seller or buyer client, here's the market conditions. It's 1 month of inventory. And remember, most of the standards say 6 months or below is the seller's market, above 6 months is the buyer's market. So 1 month is almost what we term a strong seller's market. So it's a very healthy seller's market. And you can see there's only 3 for sale, 2 under contract, but they're closing almost 4 a month. And also, the program is also showing these 3 for sale, they're still for sale because they're just pushing their prices a little too high. You can see where they're valued, and you can see that these 3 are above where these 2 that are under contract. So the buyers saw value in this one and value in this one, but they haven't found value yet in these 3. So that's just kind of part of the analysis, but over time, this curve is moving higher. So what we're doing is we can take any one of these closed comps. I'll just pick any one at random. So this one closed on March 15th. So what the program's doing is taking that same set of closed comps. So we have 44 closed comps here. And what we're saying is those 44 closed comps based off of when they sold, we believe the average house at this square footage is $4,869 higher because of appreciation compared to those closed dates. Again, if you go to your list and you look at your dates, we're looking at all these closed dates, whatever was entered into your closed set of comps, and we're analyzing based off of today's date, how do we compare on appreciation to those? And you can see from an analytics tab, we're saying that's a credit of $4,869. And visually, what you can see is this blue house is slightly above the curve line. And what this is reflecting is, because remember, I haven't made any adjustments here. It's all average, right? So 3 stars is average, so it's all average. The reason why it's higher is because of a combination of the seasonality is higher and the market conditions are higher. So what we're saying is the average house would close above this curved line based off of both appreciation, and the seasonality. So while we're on this specific one, what I wanted to show to you is that if I go change the date, so let's put these numbers in, this number in our head, 4869, right? So if I go change the date and I say, okay, well, on an appreciation basis, thanks for the listing appointment today, but we really want to wait until July 24th to list. So if I go 1 month forward and I put July 24th and I go back to my analytics, Well, now look, it's made a higher adjustment of 55.18. So what this is taking into consideration, again, the 44 closed comps, it's taking another month of appreciation based off a historical comparison of inventory to historical appreciation and depreciation. So if you wait another month, we're saying the house value is going to go up based off of long-term appreciation or depreciation. However, the flip side is, look, we've passed our seasonality curve by fast forwarding. So we're getting into, for this specific market, if you're going to July 24th, you're kind of losing that school time move of buyers. So, by July 24th, most of, people with kids who wanted to move over the summer before school started have already written contracts. So the combination of the two is what matters. So we're saying you have higher appreciation because you've gone another month. However, you're starting to slip on seasonality at the same time. So if I go here and I say, I'm going to modify the search, and I just wanted to do this as the same example. So if I go modify the search, and let's do the 3-month thing again. So let's go back and let's just do from March of 2020. So let's do March 24th. So again, we're limiting it to 3 months, like we did when we were running the seasonality. So if I limit 3 months, here's my 14 closed comps, 2 pending, 3 active. Again, that doesn't change. If I generate my chart, now let's go back and look at the analytics. So in the analytics, here we go. So same house that we're analyzing, and again, the math shows 14 closed comps in 3 months. So we're closing a little over for a month, but when you average it out, 3 for sale, that's still around 1 month of inventory. It's still saying that is a strong seller's market, so it's still appreciating. However, the market conditions adjustment is lower because the time frame of these closed comps is not as far back. I mean, this one just closed a week ago, 2 weeks ago, a few weeks ago, but the oldest set of closed comp is March 24th, with most of them closing May and June. So the comps are not that old, so they're more relative to the set of data, so we don't need to make as much of an adjustment because the aging of that comp is not as old, even if it is an appreciating market. So all of that is to keep in mind of that's how market conditions is functioning and how it works with seasonality at the same time. Now let's do while we're on this. So market conditions can also take in consideration maybe not as healthy of a market. So let's do another quick search here. So again, on all of our legends, we want to show, because this is the most important thing, is it how many months of inventory and what type of market it is for your client. Because I can look anywhere in the nation, and the most important, if I only have one piece of information for each market, I want to know how many months of inventory, because that shows me how much absorption is happening. What's your ratio of active sellers compared to pending and closed buyers? How much activity is there on a buyer side versus seller side? So again, just to show you maybe not a strong seller's market, let's go make a new chart here. So I'm just going to go make a new chart, and I'm just going to pick another neighborhood. Let's do 200 square feet. So this time we're going to do residential. Let's do single family attached. Let's do south of Broad. And let's do, I'm going to pull a few neighborhoods here, Ansonboro and French Quarter. Again, which comps we're using doesn't matter as much as what the analysis shows. So let's do that. And then year built, I'll pick before 2000, so I'm not including new. Square footage, I'll stay under 2,000 square feet. So again, I'm going to go for a year. So on the search, I'll stick with a year, under 2,000 square feet, these 3 neighborhoods in Charleston, and then built before 2000. And then what I find is that here's my set of comps. And let's say I come down here and I narrow down, and let's say I want to do, oh, well, my comps are more in this area of town here. So I can come here and I can see I have 26 active, nothing under contract, and 12 close. So if my house is located in this area here, and here's my set of comps I'm picking, I just want to show you how the analysis is working on the flip side of market conditions. So again, I have my 12 close comps, so I can run this. So if I hit generate chart, what it's going to produce for me, so here's my analysis. And one thing you notice right away, there are a lot of green dots compared to red ones, right? There's over twice as many. There's 33 months of inventory, right? So let's put that in perspective real quick. And it's a weighted, what we do is we do a weighted months of inventory. It looks at how many are under contract at the same time, not just how many are active, how many are under contract. Because if I had 10 under contract and 26 active, that's a better market. So, you know, most absorption rates don't take into consideration how many are under contract, but to us, that's very critical, is to see how many are under contract. So 12 closed, this is easy math, I didn't intend this, but 12 closed in 12 months. So how many is that per month? That's 1 per month. So 1 per month, 26 active and nothing under contract. That blended inventory is 33 months of inventory, which is a strong buyer's market. So watch what's happening here is that if you look at the blue house is actually below the line. So the center of the blue house is actually below the line. And if we go to our analytics tab, look, we're saying that house that you're analyzing, you need to come down $27,000 from the average line because of the market conditions. So, and again, you can see what's happening. Look at everybody trying to sell and how many buyers are out there right now. Well, right now there's none. Nobody's under contract. So if you're going to be the one that's appealing to that buyer who does show up, you better be better than the average on price. So what this is doing is automatically, the agent didn't do anything, right? I just ran this analysis. It's reading this inventory for me. And it's saying you better get below average on that. And keep in mind, it's still a good part of the season to sell, but the market conditions are far overriding, you know, the seasonality. So you, in this market, you have to get below the average. So what's happening is over time, what's going to happen to this curve line, this curve is actually moving down because there's not nearly enough buyers to absorb all the sellers wanting to sell. And I wish I had this tool in 2008, 2009 as an agent, because you know what was happening is all the ones going under contract were all below the curve. And what is that doing over time? When houses start to sell below this curve, what is this curve doing? This curve is dropping over time. So as houses close below, and I would venture to say, when these get to the right price, whichever ones they are, I would venture to say below this line are the ones that are going to sell. But when they start selling below this line, this curve is dropping. And that's what our analytics are saying is that, you know what? We believe that this is a depreciating market on value, and you have to get below the line to get your house sold if you're an average house. It doesn't mean that nobody's going to sell above the line, but if they are selling above this blue line here, that probably means they are a superior house. You know, that they have a lot of positive features to be able to sell above average, but that average line is moving down over time. So based off of those dynamics, that's how we're reading this analytics. So the analytics are saying the market conditions are lower over time, and you can see how dramatically different these two markets are. So that's why it's critical that we don't want to summarize an MLS and share that with all the clients, because it doesn't really matter. You know, this buyer or seller who's working on a house south of Broad, either trying to sell it or buy it, you know, whichever, all that matters to them, this is what's happening south of Broad. So in this area that we selected, this is the market. This is what's happening. It doesn't matter what's happening on the other side of town. It doesn't matter what's happening in the MLS as a whole. Here is what's relevant to them. So if you're a seller, this is a great way to represent your seller and say, look, here's the market. Here's exactly where the market stands, our market conditions. We need to get below where we would traditionally be or where the comps have sold, because there's too much for sale compared to how many buyers are out there right now and how many close per month. So think about it, one closing per month, nobody else lists, it still takes you over 2 years just to get rid of your inventory. And again, this is, you know, my experience as an agent in 2008, 2009, is that you were dealing with situations like this across the board. And what you have to be able to explain to the seller is, on a market conditions basis, if there's 26 for sale and you'll be lucky to have one buyer a month, 25 out of these 26 sellers at the end of the month are going to scratch their head because they did not get a contract. One of them will, and only one. At this rate, one of them will. So if you're going to be the best house out of 26, no matter what your square footage is, you better be the best value out of the 26. And the only way to do that is adjust accurately for the market conditions. So it's a great way to explain to them. On the flip side, if we go back to the chart that I ran, for this other neighborhood, this allows us some room on the upside. So it allows us to say, you know what, we can push the market a little bit based off of it's a strong seller's market. So maybe we can sell above that line. So it's putting perspective in a numerical fashion and visual fashion of where the market is. Because I mean, look at this one. It's like there's only 3 green dots on here. And in 3 months, we have 14 closed sales. So, I mean, those are polar opposite markets. And so to average everything together doesn't make any sense when you're, talking to your clients. It's more important to say, here's what matters in this neighborhood, and conversely, here's what matters in the other neighborhood that we just shared. And they're dramatically different neighborhoods as a whole. So, again, it's good to understand both how seasonality affects the pricing, but also how market conditions does. We wrote a book, and if you go to our website, pricing.apcdata.net, the book explains 8 concepts that we go through pricing, and seasonality and market conditions are 2 of those 8 concepts. And each chapter is dedicated to one of those concepts. And what we do is we spell out specifically examples for buyers and sellers of how it affects their client and themselves as an agent. So it breaks down exactly what we're talking about in this session, and it dives into the details of it. But the nice thing is you don't have to worry about the math. The math is being done for you. You just have to be able to convey the concept and why this is affecting their house price and where to list and the decisions to make. So I hope that was a good, just don't want to take any more time up, but I hope that was good for everybody. We do have a recording of this video. If you want to reach out to us, we can send you the recording, but if you want to go to pricing.apcdata.net, or if you're on your website, you can hit us up here and we can send you a recording of this video. But it's seasonality and market conditions are key. And while we're on seasonality, it's going to be different for every MLS, but every MLS has a seasonality. Some might be more dramatic than others, but every MLS experiences better months and worse months in their local market. Thanks for everybody's time today. Hope you'll join us for our next webinar, and we'll continue to do these in future on specific topics or on pricing as a whole. So everyone be safe out there, and thanks again for your time. Have a good day.